Hello everyone and welcome back to our next weekly episode dedicated to a fascinating world of accounting. In our previous lessons we've explored the balance sheet, assets and liabilities. Today we are introducing another key financial statement, the income statement. The income statement tells the story of a business's financial performance. It tracks revenues, costs and profits or losses over time. Let's get started. We have learned that the balance sheet captures financials of a company at a specific point in time. But the result you see on the balance sheet didn't appear from nowhere. It was generated over a period of time. Real world requires time. As they say, time is money. To understand what was happening with the business over a period of time, we use income statement, also known as the profit and loss statement or short P&L. In our lessons we will use both names interchangeably. So what is income statement exactly? It reflects business's activity over a certain period of time, showing whether a company is making a profit or incurring a loss during that specific period. It can be months, a quarter or a year, for example. If you report monthly, to get to a quarterly or an annual income statement, you simply add up individual months. A typical income statement structure includes revenue, costs and resulting profits. Or losses. Not all businesses are profitable. And even if you have profits for the year in total, you can still have some months with losses. Let's start from the top. Income or revenue normally has two sources. One is revenue from the sale of goods, for example the apples which we were selling when discussing the balance sheet. Another one is revenue from the sale of services, as an example cleaning, driving, teaching and so on. Now to the cost part. The costs can be also split into two major categories. The first one is the direct costs which are required to generate the revenue. In our case that would be the costs of the apples we have bought. When we sell the apples, their cost would be exactly the amount of money we've spent to buy them. But direct costs could also include the transportation and packaging costs, for example, to deliver the apples from the supplier or to the customer. Those costs will also be direct. The second category includes costs like salaries, marketing, rent, IT costs and many others. It will also include interest we pay if we have the loans, and of course taxes. Yes, taxes are the cost of running the business. And they say there are two things that are certain in life, and one of them is taxes. Here is an example of a simple income statement. Revenue is recorded on top as a positive amount. It generates value for us, so it's positive. Costs are recorded below and are normally shown as negative. Let's put them in brackets to show that they are negative, as an alternative way to the minus sign. The difference between revenue and costs results in profits. If revenue is higher than costs, you generate profits. If the costs are higher than revenue, the business will generate losses. Then come taxes. After you deduct taxes, the result is called net profit or net income. Often you can also come across the name profit or income after taxes. Or it can be loss, of course. If you incur losses, there are normally no taxes to pay. Let's see how income statement works in practice. But we will start with the balance sheet where we have recorded our resources. The resources which we use for transactions. You always start activity with something you have to offer. Imagine we have bought 5 apples for $10 each from our supplier on credit, as we did in our previous lessons. As a result, we have $50 of apples in inventory and $50 liability, payables we owe to our supplier. So that the balance sheet still balances. Let's not forget about that. Let's put our income statement to the right. Now let's sell our 5 apples. These apples cost us $50. That is exactly the cost for us. The cost of the sold apples, $50, is going into the cost of goods sold, as a negative amount. And we of course remove inventory from the balance sheet. Remember the double entry accounting we discussed in the last lesson? Yes, it applies here as well. Every transaction has two sides. If we record costs, we need the second entry. That would be reducing inventory, the source of our costs. So as we want to make some profit, we set the price at $12 per apple, meaning our revenue will be $60. Now we have zero inventory and received $60 of revenue. By receiving revenue of $60 with the cost of $50, we earn a profit of $10. Congratulations to us, we've made our profit of $10. Good. Since we sold apples and received cash for them, we must update the balance sheet. Again a double entry. So revenue will be the first one. The second one, in our case, will be cash, as we directly received the cash. Let's record $60 in cash. The balance sheet doesn't balance now. How do we fix it? To make the balance sheet balance, we add the $10 profit to equity. Why? Because profits belong to us. They are also so-called retained earnings and increase the company's value. And now the balance sheet balances. Good. Now we can pay our supplier and settle our debts. As a result of those operations, we have $10 of cash reflecting our profits of $10. You see, the balance sheet reflects the end point, the result, while P&L keeps track of the transactions we've made. How much we've sold, how much it cost us, how much profit we've earned on those transactions. It tells us a story of our business, how we earned our profits, how much time we needed for that, and how successful we were. But here is something important to remember. The income statement doesn't track cash movements. Cash movements you can see only from the balance sheet. Imagine we haven't received cash of $60. Your sales would result in receivables on your balance sheet, no cash. Your cost could be payables, no cash paid yet. We would still record $10 of profits and can have zero cash at our hands. But from the P&L you won't see it, you only see the fact of the sales of $60. So, we have earned profits of $10. These earned profits are now part of the company's funds. What can you do with them? There are two major ways to spend the profits. Profits can be reinvested into the business. For example, we can buy more inventory. Or profits can be distributed to the owner as dividends. Profits are the ultimate goal of any business. Without them, a business cannot sustain itself over time. So let's summarize what we've learned today. The income statement can also be called profit and loss statement, or P&L in short. Income statement tracks revenues, costs and profits, but no cash movements. Revenue minus costs gives us profit or loss. Profits increase equity and are reflected on the balance sheet. Losses decrease equity. In our next lessons, we'll explore different types of revenue and direct costs. Thank you everyone for watching and hope this lesson helped clarify the profit and loss statement. Don't forget to like, subscribe and hit the notification bell for more lessons on accounting and finance. See you in the next episode.